Welcome to the Power of Capital, how to fuel the growth of your business. My name is Walter Acuna, and I'm a senior business consultant for Chase. I've been in the industry since 2003. I work for several banks, such as Washington Mutual, Bank of America, Wachovia, Plaza Bank, also a CDF5 called Craft 3, and finally, I'm again in the banking industry with Chase. I cannot tell I've seen it all, but I have, a lot of experience with businesses. I work with pretty much all industries. I'm very familiar with operations, marketing, financials, and I hope that this workshop is going to be helpful for you guys. There is a lot of information we're going to cover today. And if you have any questions, please write them down, send me an email, or call me on my phone. At the end of the presentation, you are going to have all my information. And let's start. So why we're here? All businesses deserve an equal opportunity to improve themselves in the marketplace. Why now? The coronavirus and the struggle for justice continue to change the business landscape. The information you learn today will help you better navigate these challenges. Coronavirus pretty much changed our lives. While we were doing business before, it's not the same way we're doing business today. Restaurants get more deliveries today than before. We order food for deliveries more than before. A lot of our training is still online or hybrid. However, the fundamentals still matter. In this time, tested approaches can help any business owner gain traction in times of crisis, in times of calm. What do we mean by fundamentals? When we try to get capital or we apply for a loan, every single financial institution out there is going to ask for the same information. So today we're going to cover that and how to approach the different alternatives we have in the market to access to capital. So that's why we said the fundamentals still matters. And I understand sometimes business owners feel overwhelmed because there is a lot of information that lenders ask from you guys. However, they are important because lenders are not trying to deny the loans. They are trying to mitigate risks. And that's what the information does, is creating a mitigation for the risk that the bank is going to take. There is a misconception out there that, I have good credit, so I'm going to get a loan. And it's not that simple. When we talk about personal loans, credit score, is very important. And pretty much whatever income you can prove you have plus your credit score, I cannot say it's going to guarantee you access to capital, but it's going to help a lot. But in case of a business, it's a little different because we are assessing the business instead of the person. The person is still going to guarantee the loan, but we need to know if the business is making money. And the only way to know that is through financial statements and information that you can provide to the lenders. So that's why fundamentals still matter. They are very important. Do you know that 39% of minority-owned companies feel their primary bank contact treats their business owners with respect? So what this means is low. We need to change that. 39% is too low. The banking industry has underserved minority entrepreneurs. So it's time to change. And there is a lot of talk right now about this. Business owners, especially minorities, sometimes are afraid to go to a bank or a financial institution for ask for money because so many times they heard, I'm sorry, I cannot help you, or your credit score is not there. Or sometimes institutions just don't give a reason why they cannot provide the capital they need. So people are afraid in general, entrepreneurs, most of the time, and minorities even more. So that's what we're trying to do. We're trying to change that. And That's why we are trying to educate them through workshops, and this is one of the initiatives Chase has, and this presentation is part of that. So how confident do you feel about your knowledge of the business credit options are there? I like you to ask that question to yourself, and to have an understanding, how confident do you feel about yourself and the information you know right now about the credit options out there, from 1 to 5. Think about it, write it down, and let's see if this is going to change after the presentation. So what are we going to cover today? The presentation has pretty much 7 parts. We're going to talk about think strategically about cash flow. Cash flow is very important when you try to apply for a loan to get capital, and also for your business. Does your business need to borrow? It's important to know this. Do we really need the money, or we don't need the money, or why are we preparing ourselves if we ask for money today to use it in the future? How are you a good investment? That's another question. How's your business going? Do financial institutions want to invest in your company? What financial data is important? And I'm going to try to explain why it's important, because it's important that why is important for the business owner, so then they don't feel like, hey, this is too much information they are asking. I'm going to explain a little bit about the why. What are your credit options out there? As I said, when we try to get money, usually we go to a bank, but that's not the only option. We have other options. We're going to talk about those today. And part of these options, there is SBA loan programs. The SBA is Small Business Administration. There are some really good terms with these loans. They provide some advantage. So we're going to talk a little bit about this as well. And at the end, we're going to try to feel confident and we can start building our own empire. So let's talk about thinking strategically about cash flow. Cash flow is so much more than money in the bank. Having money in the bank doesn't mean that you have cash flow. Having money in the bank means that at that point in time, you have money. But in order to know if we have enough cash flow in our business for it to operate, needs a little more information. So how businesses use cash flow? The businesses use cash flow to pay suppliers, to pay employees, to pay rent space, to reinvest, and there is other additional more to pay utilities, and if we are buying our building, to pay mortgage. There is so many things that we can use cash in our business. So there is in page 14 or in page 4 of your workshop, in your workbook, which we share through the link in the virtual booth or with BizFair professionals, they send you that information. Talk about Bright Tech. Bright Tech is a company that is having troubles with their cash flow. It's a case study, but basically they are really happy because they won several contracts and business is booming. The owner is taking the employees for lunches, dinner, to motivate them because everything is doing great. However, one day the owner realized that her business account is overdrawn. And what happened there? If business is doing great, why am I overdrawn? So then she realized that she sent several invoices and the business is going to get paid in 30 days, May 30, the type of invoice she sent. So even though in paper, the company shows that have money, she is in trouble and probably getting out of business because it's not going to get enough cash on time to pay for several of the bills. So I'd like you guys to read about this case, which is really, really interesting. So at the end of the case, you will notice, number one, the cash flow needs to be managed. That's very important. I can tell you many times, I talk to business owners that because they are busy, because they have too many things to do, they don't manage the cash flow and they get in trouble. But again, that's one of the key points for your business. You need to manage the cash flow in order to operate it correctly. Also, an efficient process for payables and receivables can help you better manage the timing of revenue and expenses. When we talk about payables and receivables, is money that we are going to pay for our suppliers in case of payables, and receivables is money we're going to receive for customers. And there is a gap always between them. And this is based on the terms that you're giving money to your suppliers, or you're giving the terms to your clients. Some clients pay immediately, some clients pay in 15 days, some clients pay in 30 days. And you can even offer better terms based on how they pay. If they pay right now, you can offer a discount. If they pay in 15 days, it's going to cost a little more. If you pay in 30 days, it's going to cost a little more. The same way in receivables, you have in payables, you have your suppliers, and the way you pay them, is going to give you wiggle room to pay internally for your other expenses. So it's important to have a good management and timing of these to have cash flow in your business, or as the number 3 says, borrowing capital strategically can help ensure you have cash when you need it. As I mentioned in number 2, if you're going to have a gap between your payable and receivables, a line of credit is going to be able to cover this gap. So then you always have cash in your business to cover for those expenses. And the idea is that borrowing is temporarily. You borrow X amount of dollars for 15 or 30 days to cover for expenses. Then as soon as you get paid, you pay that back. Unfortunately, sometimes business owners get in trouble because they use lines of credit and they make it permanently. And then, the line of credit after a year needs to be renewed, but it never revolves, and then they get in trouble. But again, the key is knowing, learning, and then doing, managing the line of credit correctly, and then so you don't get in trouble. And it will going to help you tremendously. So now let's talk about that. Your business needs to borrow. How can we determine this? Let's talk about this. Remember that when you borrow capital, you need a plan to pay it back. And this is what I was talking when the banks, or any other financial institution is asking for information. What they want to be sure is that you have enough money in your business to pay them back. Banks, they are interested in your collateral. They are not interested in the asset of your business. You said, okay, I need X amount of money and I own my house and it has equity. Or I own the building in my business and has equity. So it's not important the income, which is not true. Income is very important because, as I said, the bank doesn't want your asset. They want cash to get paid, so then they can continue creating more loans for other clients. Now, why they don't want the assets? Because it's also hard for a bank or any financial institution, if a loan goes bad, to try to sell those assets. It costs money, costs time. So for example, if a restaurant borrows X amount of money for equipment, the equipment, let's say, is $100,000 to buy it. That equipment for $100,000, the liquidation value is just $10,000. So at the end, the bank is going to lose $90,000 when they get the money back from the equipment or when they sell it. And don't forget about the fees for whoever is going to sell or try to sell that equipment. So at the end, it's probably going to get, who knows, $5,000 out of $100,000 loan that was collateralized by equipment. So that's why banks want their money back. And it's important for you to know, because sometimes if you're borrowing money and you don't have enough to pay, how are you going to pay? And then your credit is going to get affected, and it's going to create a problem for everybody. So it's good to know in advance, what's going to happen. So what lenders want to know? How long have you been in business? Important. Are you a seasoned business owner, or are you a startup? And based on this information, They can determine, interest rate, they can determine asset risk, those type of things. Is your business profitable? If you are a startup, probably you're not profitable yet. However, bank is going to ask for projections, and are those projections profitable? And how realistic are they? So it's important. Is your business seasonal? I have a client that owns a gift shop. This gift shop is very seasonal. The season is Mother's Day, Father's Day, 4th of July, and Christmas. So those are the biggest days of sales of the years. Any other days, they don't sell as much. There are other business like landscape. During the summer, they have a lot of work. During the winter, some of them they don't even work, or they do something else because it's seasonal. We need to know that in order to see if we have enough cash to pay for our debts. Do you need to build credit? What happens if you don't have any credit? As I said to my clients, it's better to have no credit than bad credit. Or for your business, are you borrowing so then your business can create some kind of a credit history in order to get better terms for your suppliers? Or are you looking to expand? That's another good point. If you already are established business and you're trying to expand, it's probably going to be a little easier to ask for money to a lender, even though they're still going to ask for a lot of information, but it's probably going to take a little less time because you're a seasonal owner and you're already successful. We need just to assess what's going to happen in this new location or with this new line of business. Also, with new equipment help your business. If you're expanding, you might need equipment. I have a client that is specialized in pest control, and they needed new equipment, so they were seasonal, and this is going to save them money in the long term. So I gave some money to them. So let's talk about credit. What is credit? Credit has different meanings based on context. It can mean creditworthiness or credit history. In this presentation, we generally use credit to mean an agreement between a borrower and a lender. So as I said, credit is an agreement between a borrower and a lender. Let's take a look at the bigger picture. In your workbook, there is on page number 6. We're going to step back and look at the factors that might affect whether borrowing right now makes sense for your business. We're going to talk about the environment. We're going to talk about operations and opportunities. So I highly recommend, this is homework for you, to take a look at your worksheet, fill this out, and try to be as honest as you can, and try to find the information that you need. In that way, you will have a better understanding of where you are at. So that's homework for you guys. Why are you a good investment? Let's talk about this from the bank's perspective. You are your business' most important asset. So a business owner is the one that is going to run the show. If you have a restaurant and you are an experienced, let's say, chef, is going to reflect in the type of food you make, probably in the flavor, and attracting customers based on that. Just one example. Let's say you are a good, you're good at sales, and you were selling cars for years, and now you have your own car dealer, So now you have your car dealer, and you talk to your clients, sell your cars, and everything was great. At the end, the person, is the most important asset there for the business. And in that context, we're going to see some aspects from the bank's perspective. One is leadership. A bank wants to know why you are the right person to lead this business, which means, are you experienced? Or maybe you are not experienced in certain areas, but you hire the right person to be in charge of those areas. So then you focus in the part that you're experienced. That's one example about leadership. And leadership doesn't mean that you are like a manager, not necessarily, like you like to manage people. And leadership is more than that. Is how your relationship is with your suppliers, relationship with your clients, and again, even having the right people in your team to be in charge of certain areas of your business. That's how you show your leadership. Of course, how you manage the cash flow. Usually, when someone open a business, the first things they do, they don't necessarily apply for a loan, and they get financed through family and friends or maybe savings. And how good were you managing that cash before you go and try to access to capital? So that's critical in order to secure a loan. So that proves that you know how to manage cash for the bank's perspective. And of course, we talk about collateral. When I said the bank is not interested in your collateral, it's true. So we cannot raise everything in collateral. However, there is a small chance, or that you might not be able to pay that bank. So that's why the banks ask for collateral. But a loan is not based on collateral 100%. It's just like a portion of it. So in this case, you need to include assets with cash value as collateral to make easier to get a loan. There is no institution that is going to give you no collateral loan. There is always, even if you don't have any valuable assets, the business is going to be the collateral of your loans through a UCC filing, blanket UCC filing. Let's talk about personal credit and business credit. So personal credit tracked via your social security number and typically presented as a score between 300 and 850, also known as the FICO score. It's very simple. When you apply for a personal loan, they ask you for your social security number. They ask you for how much you make. And then based on that information, immediately they can tell, okay, we can give you X amount. We can give you a car loan, a credit card, or whatever you're applying for. It's simple. The business credit is a little more complicated, as I said, because it needs information, but this is a little different than the credit score. The business credit is tracked via your employment identification number, or EIN, and typically ranges between 0 and 100. To know, a single organization provides a centrally recognized store. So there are like different companies out there that provide this information. So there is not a centralized base. Some small financial institutions, they don't even report you on their credit bureaus for business credits or personal credit. So that's probably a good question if you want to build credit, if whoever is providing the loan is going to report you to the bureaus. Okay, why financial data is important? We're talking about all the paperwork, and business owners are scared about this. I started talking in the beginning. Loan officers want to feel confident that extending credit to your business will pay off. Again, financial institutions don't want your collateral. They don't want your business. They just want to get paid back. In simple words, that's what they want. Tax returns. This is one of the requirements that they are going to ask you. Tax returns, very important. Usually last 3 years tax returns. Newer business owner will need to provide both personal and business tax returns. Well, usually all financial institutions ask for both. They ask for both personal and business. If your business is well known for the bank, or you're a seasonal business owner, have years with your bank, the relationship is great, probably it's going to be a little different. But usually they ask for last 3 years personal and business tax returns in any single application. Let's talk about balance sheets. Based on what you include in your balance sheet, your bank will calculate a few important data points. So a balance sheet is a financial statement that is going to show your assets and liabilities. Assets, how much money you have in the bank, how much equipment you own, or if you own any real estate or any other asset, is going to be listed there as a value. And it's also going to show your liabilities. Liabilities is going to show, line of credit, loans, maybe mortgage for your business, anything. Why is important? Because a bank is going to provide just an X amount of money based on how much you own. If you owe too much, or you have too much balances, they need to look at the income and determine, okay, they can have additional debt, or maybe you are maxed out with your debt, so you cannot have additional debt because you are not going to be able to pay. That's another point. So in order to determine that, we do an analysis with all your loans and the different line of credit you have to see how much money you pay every month and to see if you still have some room from your business in order to pay for the new debt. So that's how we use the balance sheets. Of course, profit and loss statements. Profit and loss statements, they are going to show how much income you have, how much expenses you have, and how much money you're making. And this information is after you take your dividends or you take a salary out of your business. So it's pretty much how much money is left after, as I said, payroll, all the expenses, and after your own money you're making for yourself. And if this number is enough to cover for all current debts plus the new debt that you're asking for, the bank is probably going to approve your credit. So that's why it's important. Now, in the beginning, we talk about taxes. Why do we ask? If I'm going to provide my profit and loss, why still I ask for taxes? Or if I'm going to ask for my taxes, why are we still asking for my profit and loss or balance sheets? Because the business taxes have the same information. The reason is, let's say you are asking for money on July or in August. The only way to know the bank to know that you are making money in that period is knowing how much money you are making from January to July or to August or to whatever month you are asking the money for. So we take a look at that, and in order to see if those numbers are accurate, we're going to compare your year-end profit and loss statements with your tax returns. If they are fairly matched, that means your internal financial statements are fairly accurate. If they are off and very off for several dollars, then the bank or any financial institution is going to see like, okay, how accurate are these financial statements you're showing me? Because there is no other way to know how much money your business is making. We use just financial statements. There is no other way. So that's why we ask for financial statements as well as tax returns, to learn how accurate your profit and loss statement and balance sheets for, at any period they are. That's why it's important. Let's talk about your credit options. There are a lot of ways your business might be able to access to capital. Let's talk about them. One of the easiest way to get money from a bank or a credit union is for business credit card. They are easy to access and use, but require a careful management. What are the benefits of a credit card? You have a cash flow management. You have access through online banking, and you can see your transactions immediately after you use it. They have convenience and control because you can have a bank that provides share credit card, so then you can give that credit card to your employees so they can buy supplies or they can travel and do business expenses and have a consolidated statement so they can see, and then your accountant is going to be able to immediately see where the money was expended and all that. So you have convenience and control. And of course, security and service. You're going to have access to online banking immediately. If there is some fraud, immediately you're going to get the money back and they're going to cancel the card. So there's the security there. And you can even have rewards, which is really good for some companies or business owners. If you like to travel, or if you travel a lot, or just, as I said, if you like to travel, and if you can get a rewards card that give you points to travel, and all your expenses you do with a credit card, you're going to accumulate those rewards, and you can travel for free or get 1 or 2 airline tickets for free for the whole year. That's one. Or if you like restaurants, or I don't know, you are even fan of the Seahawks or something, there are credit cards out there that you can get points, and then you can get tickets at discount prices and all that. So it's so many options out there. And so that's one is the benefit for a business credit card. Business line of credit. It's a flexible option that doesn't have a fixed payment schedule, but will expire at some point and will need to be renewed. A business line of credit is different than a credit card because credit cards are approved, you have a limit, and pretty much you can have that credit card forever. A business line of credit, they don't give you a card. They give you a line of credit that is going to show when you access online to your accounts as a line of credit, so you can take cash out of this line of credit. However, the line of credit is renewable every year. Let's say you have $50,000, $100,000 loan. This line of credit, sorry. So this needs to be revolved every month, every day. However, it needs to go up and down, up and down. And then at the end of the year, it needs to be paid off the whole amount. And then if you want to renew, you need to send paperwork to your bank, and then are going to see if they're going to provide again the same amount, or maybe they're going to decrease the amount, or maybe they can offer more money. So that's why it's different than the credit card, you know. And it's access to cash. That's also a main difference. You don't have to, the company you are going to pay or your supplier, they don't have to accept a specific Visa or MasterCard or something. You know, you can just transfer your money from the line of credit into your business checking account. You write a check, or you pay, or cash, and it's good to go. What are the benefits? Funds for emergency expenses. You know, as I said, it's cash, it's available. Operating capital, you know, to pay payroll or any other expenses that you might have in your business from operations. And on-time payments, those are also the benefits. Business term loans. Business term loans are different than line of credit because, as the name said, it has a term. You know, must be paid within a specific time frame, and the lending process for term loans is often more rigorous than the revolving credit options. Term loans, if they are a 5-year term, you need to pay the loan within 5 years. You know, it's not like a line of credit. A line of credit, as I said, is renewable every year. Term loan is going to be paid off in 5 years, 3 years, or whatever term the bank told you you're going to pay, or what you seek at the time. And the payments are fixed. Let's say you have a loan for 5 years and your payment are $500. You're always going to pay $500 every single month, no matter what. If you say, you know what, I want to pay in advance $1,000, okay, let's say it's $5,000, and your payments are $500. You pay $1,000 in advance. The principal goes down from $5,000 to $4,000, but your payments are still $500 per month. However, because the principal went down, the term went down as well, because now you have less payments to make, but the payment is still fixed. So instead of being 5 years, now it's going to be 4 years, just to be an example. So what are the benefits for this, or what do you use this for? For large purchases, equipment, real estate. You know, equipment, usually the term is the life of the equipment, could be 5 years, 7 years. Real estate, you know, commercial, 25 years. Residential, 30 years. Capital for expansion or growth, or long and more predictable repayment schedule. That's a benefit. You know exactly how much you're going to pay, not like the line of credit. Line of credit, you pay interest in the amount that you're currently borrowing. You know, if you have a line for 100,000, you're going to pay interest, and you borrow 50,000, you're going to pay interest in the 50,000. If you borrow 10,000, you're going to pay interest in the 10,000. With a term loan, you're going to pay interest which is fixed. Again, that's a benefit to know. Additional sources of capital. There are other ways to fund your business beyond traditional banking products. You know, you have available banks, credit unions, but there is also other options out there. And one of them are CDFIs, Community Development Financial Institutions. They have different guidelines than banks. They are really focused on the mission of the business and the impact in the community. If you're going to create jobs, if you are a minority, if you have your business on a low income census tract, if you are in some kind of energy efficient line of business, those type of things, CDFI loan. Or if you're a startup, sometimes it's hard to get money for startups. You can get a CDFI loan. Venture capital, these are investors. There are investors out there that they would like to invest money, but they're a little harder to get. Money harder to get because usually they want businesses that can be replicated. So if you own a business, they want a business that is going to grow fast and can be replicated, like franchise, for example. Those are really attractive to venture capital. Not always. I'm giving you an example. But yes, they want you to grow fast is usually one of the requirements they're looking for. And there is also a small business grant. With the pandemic, there was the CARES Act. Government gave a lot of grants opportunities, cities, counties. There are, I think, still some opportunities out there for grants. So that can be another interesting source of capital for your business. Let's talk about SBA loan programs. So SBA, Small Business Administration, helps small businesses meet certain qualifications to obtain financings when they may not be able through normal lending channels. So SBA is an enhancement, pretty much. The SBA is going to provide a guarantee for your loan. If you go to a bank, usually it's through banks or financial institutions. You cannot go directly to SBA for money. Usually you ask your bank or any other financial institution if they have SBA loan programs, or maybe when you talk to your banker, they are going to notice or realize this guy is a good candidate for an SBA loan. Usually startups, unfortunately, banks sometimes they don't want to take the risk for a startup because they don't know for sure if they're going to be successful or not. However, the SBA is going to guarantee an X amount of your loan amount. Some programs go for 75%, other for 85%, which means if for whatever reason your business fails, SBA is going to give back the financial institution an 85% of the loan amount, of current loan amount that you have through the bank. Is going to pay for you. And so that's, some institutions use that as collateral, for example, or short up with collateral. You have, I don't know, 100,000 and you own an equipment for 20,000, and so you're still short 80,000 in collateral. SBA loan can cover that shortage. So it's really, really interesting program. We're going to talk a little bit about the different options we have with SBA as well. So SBA reduces the risk to a lender if a loan goes into default, as I mentioned before. This enables lenders to work with businesses that have potential but wouldn't otherwise qualify for a business loan. What are the benefits to get an SBA loan? They have more time to pay off the loan. Some loans for a regular bank or a regular loan, you can go for like 5 years, 7 years. With SBA, you can go up to, let's say, 10 years or 20 years, depending on the program. Sometimes, and because you are extending the term of the loan, that means lower payment options. That's another one. Also, there is no down payment options out there for a business loan. You always have to put something as down payment. Even if you're a startup, if you want to start your own business and you need 100%, $100,000 to do your project, they want to see 10% or 20% down as your equity. So you need to have some cash there, 10,000, 20,000. All depends on the type of business. However, the SBA loan is going to ask for lower down payment than traditional loans. So that's another benefit for you. And of course, because SBA is going to guarantee the loan, they have some additional fee that traditional lending don't have. And the benefit of this loan is that you can include those fees into the financing. Also, any single loan has closing costs. And sometimes you cannot include the closing costs in the loan. All depends on the financial institution you're using. However, in SBA, you can include those in your financing. So that's also another benefit. And as I mentioned before, open to businesses that are short on collateral. are not yet operating or have a lot of debt. You know, financial institutions, they look at certain guidelines. So if your business already is in debt, sometimes they cannot provide more. But the solution might be an SBA loan, so they can get, you know, a little more risky in that particular case. They can go riskier in that particular case, you know. Or when they say they are not operating yet, is because it's a startup. So SBA loans are a great option for a startup. So who's eligible for an SBA loan? For-profit businesses with less than 15 million in tangible net worth and have generated less than 5 million average net income over the past year. So this is really wide, is really big, you know, a lot of businesses qualify. 5 million average in net income, that's a lot. You know, and less than $15 million in tangible net worth, that's also a lot. Net worth is how much assets minus liabilities and how much money after that subtraction you have. You know, so 15 millions is a lot of businesses are going to qualify. Really good program. SBA Express. So SBA Express, this is a quick turnaround program that allows you to borrow up to $350,000 as a term loan or a line of credit. And as the name says, it's express, so it's fast. You apply within a week or 2 weeks, you get the money. You know, so that's a really advantage, because sometimes we get new contracts or we have something, and then usually the underwriting takes some time for regular financing. The Business Express is going to overcome that issue. So let's give some examples. In your workbook, again, Gibson Engineering, this is page 16. They show you a case study, and basically the owner needs $200,000 to build a showroom for his latest concept. You know, so with an SBA Express, he can put down 10% and wrap this into a 10-year loan. You know, 10% down is really good. Usually, banks, financial institutions ask for 20%, so 10% down is half of it. It's really great. And again, the fees can be wrapped into a 10-year term loan. Again, based on, in this case, this is for to build a showroom, it's tenant improvements. Probably a bank is going to give you 5%, 5 years, sorry, 5 years term. But with an SBA, you can go up to 10, so payments are going to be lower. You know, this is a great example of using an SBA loan, in this case, the Express loan. SBA 7A. 7A can go up to 5 million and ranging from 7 years for working capital until up to 25 years real estate. This is a really, really good option for SBA. Usually for working capital, again, banks, regular financial institution, they look at maximum 5 years. You know, with SBA, you can go up to 7 years, which is going to make your payments lower, you know. And these are term loans. Great, 5 million. You can qualify up to 5 million, great. For real estate, 25 years is really conventional, you know. Usually people hear a lot about 30 years, but that's for consumer loans. In commercial real estate, usually 25 years is the maximum you can go. So there is another case study in your workbook, again, page number 16. In this case, it's called Kick It. You know, Carmen's ready to grow her business by acquiring a crosstown rival. So this is for a business purchase. She's going to put down 40%, and she's able to get a 10-year SBA loan for $400,000. That's the other advantage of SBA. You can purchase another business, you know, with those funds. So, and again, probably the 40% is 10% down. It's really, really good program. I highly recommend to take a look into it. Let's talk about SBA 504. This is for long-term fixed-rate finances to help business owners buy, expand, or renovate owner-occupied properties. This is for commercial real estate. There is no maximum loan amount, and go up to whatever. And the SBA and lender each make the rent loans for a portion of a total amount. The SBA usually use two lenders. One is called the CDC, the Community Development, not remember the other C, and the bank. And between both of them, they're going to provide you with the capital you need. And then, of course, you know, the rates are really, really good between the both of them. and the risk is shared. That's why they usually use two financial institutions. And this is for commercial real estate. I believe you can go up to 25 years also for SBA 504. There is another example here in your workbook. It's on page 17, and it's MDA design. The owner, Mona, wants to expand, but her business has never borrowed before. This is for no business credit in this particular case. So an SBA 504 loan program allows her to get a 25-year fixed loan for $1 million with just 10% down. And for commercial real estate, banks are going to ask for 20%, SBA is going to ask for 10%. Great program. I highly recommend. I have several clients going with SBA 504s, really happy. It's a really good program. Now, building your own empire. In this case, it's like, okay, now am I ready to ask for some money? Do I feel confident that I can get money? I like you to think about, how you started with the presentation and how you are finishing the presentation. How confident do you feel about your knowledge of business credit options? Not confident at all or very confident, number 5. I hope this presentation can help you. And again, I'm going to be available for you guys for any questions you need. More than happy to help you. And I like you guys to write down those questions, send me an email, and we will talk about them, in a one-on-one coaching. Now, Chase has this great program called the Entrepreneur Program that is available for any entrepreneur out there. And I'm a senior business consultant with the program, which we are offering Coaching 101. And this can take up to 6 or 9 months into the program, but we can talk about anything you need, financial statements, cash flow, marketing. We can talk about loans. And you don't need to be a Chase client to apply and to be in the program. That's the beauty of this. This is educational, merely educational. I can help you with anything that your business needs. And of course, I don't know everything, but I have a lot of resources that I'm really good at. I have a lot of resources. So I will help you understanding your financials. I will help you understanding your cash flow. I'll help you how to do it. But still, if you need accountants, lawyers, or something, I have several contacts that can help you with that as well. So then you are ready, after you graduate from the program, continue with your business being successful. We can also help with our minority certifications. We even cover for the cost of that. So that's a really good program. And yeah, I'm available for you guys. Thank you very much for your time. It was a pleasure. And I hope you enjoyed this presentation. Thank you again.